First of all, let me get your views on that number. It was a bit of a spike, and many analysts that I've spoken to recently were pretty much expecting that inflation would moderate over the rest of the year. What are your
My view was
views?
that the inflation was going to moderate, that the transmission mechanism between money supply and prices was going to be much longer than what we saw. But if you look at the CPI clearly and in a more granular fashion, you'll find out that what we've discovered is that while the consumer price index has gone up to 12.4, the producer price index has actually not gone up that sharply. Why? Food prices have gone up. Food prices didn't go up because the cost of producing food has gone up. It's because the cost of transporting the food from the farm gate and from the manufacturer's point to the market has increased, thanks to the price of diesel.
Yeah, obviously, energy prices are something that even the central bank governor has alluded to as one of the reasons why monetary policy can only do so much in controlling inflation. But we've seen the benchmark MPR up well over two percentage points since the central bank started tightening. And there's a view that if inflation was at 13.6% in September when they started tightening, today is still at 12.4%. To what extent has that tightening had any impact?
It has had an impact, a significant impact. One, there's not a one-on-one relationship. It's not an arithmetical relationship. What would have happened if they didn't tighten was by now, at this time, you would have seen inflation at 18 or 19%. So it could have been worse. But the point is that tightening is only a necessary but not sufficient condition. The other variables are going to the price determining mechanism and equation. That means that if the transportation costs of getting, I'll give you an example, the price of flour at the mill gate is 5,600, but when you buy it at the market, you're paying about 6,500, about 1,000 naira to get it from the flour mill to the market. That's just because diesel is going at about 165, 170 naira a liter. The diesel is what is used to transport the vehicles, the big trucks and the trailers. That is one item.
And obviously, the producers have to put that higher cost on.
The distributors, the producer has already put it in because the producers are using gas.
Distributors.
Now, the other variable is kerosene. Kerosene goes into aviation fuel, which is dual-purpose kerosene for lighting, and then there's been a drop in power generation, so people are buying more diesel to even produce. So even the producer cost itself is higher. Now, apart from that, I think that you will still see the impact of the transmission mechanism, the price, the increase in interest rates on restriction of money supply. But there's been election spending, there's been government spending. The federal allocation for this month is 200 billion naira more than last month. So that money supply effect is going to come in. What the central bank did was to preemptively tighten. And so what it points to is the fact that there might be a need to tighten some more. Razia Khan was of the view that we are not done yet. But at the same time, you have to align the interests of manufacturers, align the interests of the stock market and the real estate market with the interests. So there's a kind of alignment. So the next monetary policy committee meeting is going to be very, very interesting. I'd like to be a fly on the wall there.
Well, obviously, I think many analysts are beginning to expect tightening after being surprised so many times in the past, because obviously there's obviously a move towards tightening. But let's talk about the exchange rate a little bit. We've seen some stability, relatively over the last few weeks. Even demand on the WDAS seems to have come down to about 250 million, 300 million naira, compared to the 500 million or so that we used to see right around the elections. What are your thoughts on where the naira is today and the factors at play?
I think the naira is in for a stable run, but it's still going to depreciate somewhat, because we are now going to see some money supply increases. Why do I say this? Many banks have actually begun to discount their AMCON bonds, which effectively is quantitative easing. It's increasing money supply. The impact of that is going to be there. The impact of the fact that some of the European countries and other markets are beginning to push up interest rates a little bit. The U.S. Federal Reserve is going to keep its rate constant, I think, today or tomorrow. However, the comments by Bernanke after will seem to point to the fact that he might say that he doesn't know for how much long. That means that before the end of this year, we might see rates go up from 0 to 0.25 to slightly higher. And that's going to affect things. But basically, I think what the central bank has done in managing the currency without intervening too significantly has been quite remarkable. But I do not know how much longer. The reality is that a lot of dollars are not coming in. There are leakages in the system. And the dollar inflows into the system are not as high as the production and price of oil seem to suggest. But if that can be reduced and allow all the monies come into the system, then you find that it may be easier to support the currency at current levels. But my guess is that the currency will depreciate a little bit in the next few months.
Finally, many analysts, should I say critics of what the central bank is doing with tightening right now, point to the fact that the only justification for tightening really is to defend the naira, because of the fact that money seems to go chasing those dollars. What are your thoughts on that point?
No, the framework, you see, inflation targeting, for inflation targeting you need an anchor. The anchor can either be the interest rates, which is the MPR, and what impact that will have on the entire economy, or the exchange rate. Nigeria is a more exchange rate sensitive economy than an interest rate sensitive economy. If you adjust the exchange rate this minute, within 24 hours, all the prices will factor.
Simply because we import so much.
Immediately, because we have a marginal propensity to import of about 0.65. Whilst if you adjust interest rates, it will take maybe weeks or months before the man in the village will actually begin to factor that into his pricing in any form. Therefore, the central bank is wise to keep your views on the exchange rate until such a time that the structure of the economy becomes less import dependent. And also that the structure of the economy and the exchange rate mechanism is less dependent on one currency. Right now we have dollar parity. If you're tied to a basket of currencies, which is a much more complicated issue, then you may begin to say, okay, even if the dollar drops. So right now you are dealing with two exchange rates. One, the naira-dollar parity, and then the dollar, euro, and basket of currency parity. So even if you stayed constant against the dollar, if the dollar was to drop against the other currencies, your prices also, because your imports are coming mainly from non-dollar areas.